Okay, so they're in listen only mode. Should be another one.
Right, that means they can listen to us. They can hear us right now. There's no one signed on yet. Oh, yes, there are. There's some attendees. They can hear us now. Everyone who's joining, we'll be just starting in a few minutes. We're just waiting for everyone to log on, and then we will start our 1031 exchange event. Everyone who's just joining, we'll be starting just in a few minutes. We're giving everyone a chance to log on. Good evening, everyone. I wanted to welcome you to our 1031 exchange event tonight on how to sell without paying taxes. Dino Champagne and I will be leading this event tonight for you. And I know people are still logging on, but out of respect for your time, we're just going to go ahead and get started. My name is Christy Dietz. I've actually been with Marsha Reddick since 1996. I'm one of the old schoolers here. I moved to Los Angeles in '95 after graduating from Florida State University, and I moved out here to work in the music business originally in Los Angeles. And then I became an investor in 1996 with Marsha Reddick by happening upon one of the classes he was teaching at Santa Monica College. Dr. Reddick had started Marsha Reddick Real Estate in 1979. So I owe everything I know about real estate to Marsha Reddick Real Estate. I have been a realtor for 23 years. I purchased 22 rental properties through Marsha Reddick, and I still own 11 of them today. I am a staunch believer in everything we do here. I have experience with builders and developers and investors and project managing jobs. I am an advisor for Marsha Reddick as well as a realtor for the Los Angeles area for Marsha Reddick. And I do just what you do. I buy properties. I'm in a 1031 right now. I have Marsha Reddick manage my properties, so we're all in this together. I'm a mom of 2 college-age children, Harrison and Olivia, that are in school and college in California. And I have 3 dogs. 2 of them are rescues. And I quite often volunteer for an animal rescue. So who is Marsha Reddick? Well, we are full service, one-stop shop. We are an amazing real estate brokerage. We are a property manager. We are a private money lender. And we have an investment fund. And we make it possible for you to do all facets of real estate in our carefully selected areas in the United States in one place. And we have a plethora of people from you to choose from to help you make your experience the most profitable and the best for you. So our investment methodology: why, how, when, what, where, and who. So goal setting is one of the most important things in real estate, and we help you set your goals. Working with an advisor helps you do that as well. How? Evaluating your options. What are you going to do? Are you going to buy a property? Do you have a property you need to sell and do a 1031 exchange like this event we're doing tonight? When? Deciding on a time frame. When do you want to do this? Have you been pre-approved? Have you gotten everything together financially and know where exactly where you want to buy and when? What? Setting your criteria. What's your guidelines? Where? Identifying markets, landlord-friendly states, great employment areas, maybe Sunbelt states, and also who. We introduce you to all the key players that facilitate you being successful as a real estate investor. Marsha Reddick has a national footprint. These are all our boots on the ground facilities. We have offices all over California, in the Bay Area, Los Angeles, Orange County, and Riverside. We have 4 offices in Texas, New Braunfels, San Antonio, Austin, and Houston. We have 2 offices in Tennessee, Clarksville and Nashville. And then we also have an amazing office down in Cape Coral, Florida, and we handle the whole state of Florida as well. Where? How to choose where to invest? Well, there's a large amount of criteria that we look at, but some of the main important things are the job market. What is happening? And we thoroughly investigate all of this on a regular basis, if not daily basis. What is the vacancy rate there? What is the economic diversity of the area? What is the housing affordability there? Is it a landlord-friendly state, which is very important? Strong education. Is there universities nearby? What's the education like in the elementary, middle school, high school areas? And you have reliable property management, which is us, Marsha Reddick, in those areas. I'm going to turn it over now to the amazing Dino Champagne, who's the Vice President and Division Manager for Asset Preservations that we use for our 1031 exchanges, and she's doing one for me personally right now as well. So I'd like to introduce you to Dino.
Thanks, Christy. I do want to do a quick media check here. Are you seeing the slides advance? Because I wasn't seeing you advance the slides.
Yes, I am.
Okay. All right. So if I'm advancing, let me know that you're seeing them change. Okay. So are you seeing the power of exchange right now?
Yes.
Okay. All right. So sorry for the media check here. As she said, my name is Dino Champagne. I'm a division manager and vice president with Asset Preservation. We're a national 1031 qualified intermediary. As a company, we service exchanges nationwide. We have facilitated well over 200,000 exchanges. We've been doing exchanges since 1990. So I like to say this is our skinny lane in the highway. I've been with Asset Preservation for it's going to be, I'm going on 22 years. So that's how long I've been facilitating exchanges. So the information I'm going to share with you this evening is going to be basically the basics of a 1031. It's clearly not going to cover every aspect of the 1031, but we're going to go over, why people do the 1031s and the rules. So what I'm going to cover is basically the taxation associated with the sale of an investment property. We're going to go into section 1031. It's actually a part of the tax code. It's not a loophole, as some people like to refer to it, because it's in the code. We're going to talk about what is like-kind property in a 1031, the exchange equation. So how much do you have to spend? We're going to take you through the process of the exchange. So what to expect in the transaction, the identification rules. And then the end, I'm going to give you some tips on what I feel is important to have a successful 1031. So let's talk about the first thing. Why do people do 1031s? Well, when you go to sell an investment property, there's going to be potentially 4 taxes that you're going to be hit with. The first is going to be recapture of depreciation. As investors, you're depreciating the property as you're operating the property. So when you're doing that, you're lowering your real estate taxable income. When you go to sell the property, there's a tax associated with that, and that tax rate is at 25% for the amount that you've depreciated over the property. And then the remaining portion is going to be taxed at the federal capital gain taxes, which can range either 15% or 20% depending on the gain amount itself. Then there's the net investment income tax, which is an additional tax of 3.8%. Most people know it as the Obamacare tax. So if your income, for example, is more than $250,000, if you're a married couple, or a single person of $200,000, that's an additional 3.8%. So at the federal level, you've got recapture tax of 25%, capital gain tax, which can be either 15 or 20%, and then potentially the net investment income tax, which is a 3.8%. And then if you live in the state of California or any state that actually has income tax, you're going to be subject to that tax as well. So as Californians, we're looking at 9.3 to as high as 13.3. So when you're going to sell an investment property, those taxes are going to be potentially, you're going to be assessed. So when you're thinking about a 1031, it gives you the opportunity to defer paying those taxes. I'm not going to ever say the word free because it's not a tax-free situation. It's a tax deferral transaction. So if you think about it, if you sell a property and you had a tax liability, both state and federal, of $200,000 and you didn't do an exchange, then that's $200,000 coming from the sale of the property that you can't use to reinvest. So when you think about a 1031, this is a great opportunity to instead of paying the tax, use that money to reinvest and grow your portfolio. So let's talk about the pros and cons of a 1031. Well, the biggest pro is what I just said. You get to defer the depreciation recapture tax, capital gain tax, net investment income tax, and most states comply with the 1031, so state income tax. It helps you preserve your equity because you're not giving the taxing authorities your money. You're taking that money and you're utilizing it to build your portfolio. People use leverage to buy more property when they're considering a 1031. So for example, if you have a lot of cash coming out of a sale, to buy more property, you may get higher leverage. So that's an opportunity to build your wealth. Diversification. A 1031 is a federal tax code, so you're able to move from one state to another, and then you can move geographically. You can also move by asset class. So somebody might have raw land, for example, and well, raw land is not income producing, and they've held it for investment, but now they want to go off and get into something maybe like a duplex or an apartment, maybe even a single tenant triple net. And then another advantage right now to doing 1031s is estate planning. Now, unless they change the tax code, when you're doing a 1031 and you keep doing it, when the investor passes away, under current tax law, there's a step up in basis. So therefore, the taxes that they've been deferring in all prior transaction is not passed on to the heirs. Unless they change those laws, it's estate planning is a very important part to 1031s. Now, with every pro, there's going to be cons. So there's going to be certain rules that you're going to follow, and this is what I'm going to talk about through the portion of my presentation. So there's rules and there's restrictions. Another con for a 1031 is that you do not get a brand new basis in the property. Now, I don't want to go down the weeds with this, but the reality is if you're selling a property, say for $500,000, and you buy an investment property for $500,000, your basis in the new property is not $500,000. It's what you bought the property for minus the gain deferred. So you're rolling everything over, both basis and gain, into the new property. So a downside to a 1031 is you don't get a brand new basis. Lack of liquidity. What I mean by that is that if you have, one second, I'm just looking at their tech. Okay, you can't see this change of the screen. Okay,
Yeah,
are you able to?
It's saying that my screen is paused. I think you opened your PDF and I already was sharing my screen before, but I don't know quite how to get it back to that. So
Okay, let me see what I can do here. Okay, what are you seeing now?
the 1031 guidelines. I don't know.
Okay, so we're back to that. So I'm going to try it from the current slide.
But I think they're just saying screen one.
Hi team, yeah, we're only seeing the first screen still. Are we showing, is this Dino's monitor or is this Christie's?
Yeah, I'm through a lot here. That's what I was afraid of because when I
Okay,
didn't see.
yeah, so we're actually looking at Christie's screen right now, so I'm gonna switch it over to you.
Okay.
That's
So actually
fine.
this whole time, yeah, we've been on Christie's screen.
Okay. And that's fine because then she could just change it.
Okay, Dino, and if you could hit share your screen, now we should be able to see your screen.
There we go. Okay. Yeah, this was the piece that I was missing. That's what I was concerned about when I didn't see. All right,
There
can
we
you
go.
see my
Yep.
screen now?
Yep.
Yes.
Now my show's unpaused. Okay.
Okay.
I'm
All
on
right.
1031 exchanges. Is that
Okay,
the
so,
everyone
yeah,
seeing?
so, you're there?
Yes, I'm here.
Okay, so I'll just pick it up from here. Okay, so when we talk about lack of liquidity in a 1031, what I mean by that is that any cash you keep out of the exchange, you'll pay tax on. So when you're doing a 1031, you have to buy real property. So that's what we mean by lack of liquidity. Got to buy real estate. If there's any losses, you cannot recognize any losses. So it's important to talk to your tax person, which I'll discuss in the end. Is there going to be a possibility of higher taxes in the future? Always. And again, it's tax deferred. It's not tax free for a 1031. Okay. There we go. All right. So there are going to be 4 basic guidelines when you're doing a 1031. The first basic guideline is going to be the property qualification. So does the property qualify? So has the property been held for trade or business or for investment? That's going to be a guideline for the 1031. The second one is that in order to defer the tax, you have to buy property equal to or greater than your sale price minus the closing cost. You must spend all the cash and replace the debt. That's the second requirement for a 1031. The third requirement is the timeline. Remember I told you there's those rules and those restrictions? Well, you have a restricted amount of time in which to complete the exchange and in which you have to identify the property or properties you wish to purchase. So the timeline for the exchange is you have the date of closing, you have 45 calendar days to identify what you're going to buy, and I like to say you have an additional 135 days to finish your exchange. So the exchange period from beginning to end is 180 calendar days. And then the fourth requirement is identifying. You have to properly identify the replacement property in a 1031. So those are the four basic guidelines that we're going to talk about in trying to, if you want to have a successful 1031 transaction. Okay, so let's talk about the property. When you hear the term in 1031, what is like-kind property for a 1031? People sometimes get very literal to the term. They think like-kind means if I'm selling a triplex, I have to buy a triplex. Or if I'm selling an apartment building, I have to buy an apartment building. Think of this as a 1031. 1031 is investment real property for investment real property. Okay, so it's very broad. So as an investor, as I mentioned earlier, I can go different asset classes. So if I had raw land, I could go into something that's income producing like an apartment or a duplex or a triplex or even a commercial building. So like kind, very, very broad when we're talking about 1031s. Now, one of the things that comes up, because sometimes people think if they've had their primary residence, for example, and they've owned it for a long time and the appreciation is really high, I will get calls where people go, can I do a 1031 with my primary residence? The answer to that is if the last use of the property is your primary residence and it's nothing else, then the answer is no. That's a completely different tax code. A principal residence does not qualify for a 1031. Now, there may be instances where it's your primary plus investment, only the investment portion is going to be able to be 1031. Another one comes up is dealer property. So we have, there's times where people buy property to fix and flip. If you're buying property to build and sell, fix and flip, that also does not qualify for a 1031. So the key to remember about like-kind property, that has to be real property that you intend to hold for trade or business or for investment. Now, when we talk about hold, the question comes up all the time. I've been doing, like I said, I've been doing this close to 22 years now. How long do I have to hold the property for it to be declared held for investment? Well, believe it or not, the tax code doesn't have a mandated holding period. It's about the taxpayer's intent. So how do you establish intent? Well, it's how long are you going to hold the property? So some advisors might say, I want my client holding the property for at least 2 years, because that helps to show that they had the intention to hold this property for investment purposes. Some may say maybe just 12 months is sufficient because it covers 2 different tax returns. So if you've held the property, say for example, for a short period of time, it doesn't mean you cannot do a 1031. However, I would strongly recommend that if it's anything under a year, that you consult your tax advisor to determine, can you substantiate that you held that property for investment purposes? So time is only one factor. It's other factors that come into play. So sometimes you'll hear people say, well, you have to own the property for 2 years, and that's not necessarily accurate. All right. So what was your intent? Time helps you establish intent. Now, the next guideline I talked about is how much you have to spend. So I'm going to take you through an example of what's called the exchange equation. All right, so if somebody is selling an investment property for say $900,000, and they had a loan on the property for 300. There's going to be some closing costs, so we're going to figure the closing costs around 60,000. That means there's 540,000 of cash coming into the transaction. They go off and they buy a replacement property for $1.2 million. So they're taking advantage of utilizing leverage, right? Because they're buying higher. They spent the full $540,000 and then they got a loan for the difference. And so in this example here, they would have full tax deferral because they've spent all of the cash and they replaced the debt. Now here's an example of what we call a partial exchange. Here's where you sold the property for $900,000. They decided to buy a replacement property and only buy one property, say for $700,000. They received a mortgage for $260,000. So did they equal the mortgage? No, the mortgage went down by $40,000. So they didn't replace the full mortgage. And then they only spent $440,000 of cash. So in this example, as a partial exchange, they're going to pay tax to the amount of gain on $140,000 because they didn't meet the full requirement. Now, can you do a partial exchange? Is it an all or nothing system? The answer is no. You can do a partial exchange, and there's many times where people want to do a partial exchange. It's important, though, if you're going to consider doing a partial exchange, to make sure that you're consulting your tax advisor to determine that you're still benefiting from the exchange itself, because the taxing authorities are going to come after the portion that has not been taxed first. So if I have $140,000 of what we call boot, and boot in my world merely means taxable. If I have $140,000 in boot, and the gain on the sale of the property would have been, say, $300,000, I'm still benefiting from the exchange because I'm protecting tax on $160,000, even though I'm going to pay tax on $140,000. Now let's just say that my gain on the sale of this $900,000 property was only $100,000. Doing a 1031 would not be beneficial because I'm going to pay the tax on the $100,000 like nothing happened. So if you're considering doing a partial exchange, it's really important to talk with your tax advisor to determine, am I going to benefit from doing the exchange based on how much I want to keep out of the exchange or how much property I want to buy. So really important to have these discussions. So just know that you can do a partial exchange, but you just want to make sure you're benefiting from that transaction.
Dino, can I
Sure, go ahead.
want to ask you, can I take money out of the exchange to reimburse myself for rehab I did on the property that I'm selling?
That's a very common question that comes up. And the answer is, yes, you can take the money out. However, you're going to potentially be subject to tax because it depends on the money, how that money was used. So your tax advisor is going to take a look that you spent $35,000. Was that $35,000 for repairs or was that $35,000 for capital improvements? So if it was for repairs, then maybe your accountant can find a way to offset that, where even though it's going to be subject to tax, it could potentially get mitigated. But if that $35,000 was considered a capital improvement, then that increases the basis in the property, but I don't see how you get to write off anything on that one because a capital improvement is different than a repair when it comes to these situations. So if you do something like that, which is, like I said, very common, you want to see what you're going to be exposed to get your money back. All right, so it's not uncommon to do, but you just have to understand that you're going to be subject to tax. To what level and how, that's going to be up to how the accountant deals with what that $35,000 was spent for. Okay.
Yes, thank you.
So now here's another one. Sometimes where people get caught up in thinking that all I need to do is buy property higher than what I sold for. Remember, I told you, you have to spend all of the cash and replace the debt. So in this example here, we have the same $900,000 sale. The replacement property, say $1.1 million. They leveraged the property to $700,000, which means that they didn't need to spend all of the cash. So Because they did not spend all the cash, even though the purchase price was higher than the sale price, the taxpayer is going to be subject to tax on $140,000 because you cannot increase debt and keep cash. So just keep in mind, when we talk about that second requirement, you must spend all the cash and replace the debt. So when you're dealing in a transaction, make sure that you understand how much money you have to spend and how you plan on utilizing that. Could this person go off and buy a second property with that $140,000? Most definitely. All right. But you just want to just know that if you're only buying the one property and you're not spending all the cash, you're going to be subject to tax. Now, let's talk about closing costs in a 1031. There are certain expenses that are considered acceptable expenses, and there's some that are not. Real estate commission, title insurance premiums, closing fees, escrow fees, closing attorney fees, legal fees, transfer tax, notary fees, recording fees, the qualified intermediaries fees. Those are considered acceptable exchange expenses. Other expenses associated with the transaction may not be, such as prorated rents and security deposits. So for example, if you're selling, say, for a triplex and there's security deposits and prorated rents, sometimes it's negotiated between the parties that the seller will credit the buyer with the prorated rents and security deposits. Well, if the seller's doing a 1031 and they're crediting the buyer, that means the buyer's not having to bring in that dollar amount because that's a credit. So therefore that would be exposed to taxes for the seller doing the exchange. Points, prepayment penalties, lender fees, those are considered a cost of financing, not a cost of transferring the property. Paying the buyer's closing costs. Some accountants may figure that's a cost of the transaction, some may not. I would say that if you're going to be paying some of the buyer's closing costs, talk to your accountant to determine, is that something that's going to be exposed to taxes. The title policy for the lender. Impounds, such as property taxes and insurance. For when you're buying property, a lot of times, in most cases, lenders are now requiring that there's impounds. So when you're buying the replacement property, they may want 3 months of insurance, 3 months of property tax, and people go, well, I'll use my exchange proceeds for that. Well, that's not a cost of buying the property. That's a cost of impounds. That's so therefore you would be exposed to taxes. So anytime you have questions about what may or may not be an acceptable expense, you can always ask us as a qualified intermediary, but you definitely want to consult with your tax advisor to determine how your tax advisor is going to view some of those expenses and let them guide you as to what you should be doing. All right, now let's go through the exchange itself. So you have an investment property that you've listed, you have a buyer, you open up escrow. That's when my role as the qualified intermediary is going to officially begin. So once you open up escrow, now we can get into action. So first thing I'm going to be asking for is, who's your escrow officer? What's the address of the property you're selling? I'm going to be reaching out to your escrow officer. I'm going to request a copy of the contract, the title information, and then from there we prepare the exchange documents. So I like to say, when you're entering into a real estate transaction, you're going to have, the real estate function of it, such as the listing agreement, the purchase and sale contract. Once you get an escrow, now you're going to have all the escrow documents coming in. And then when you're entering into a 1031 exchange, you're going to have the exchange documents. So you've got the real estate documents, the escrow documents, and the exchange documents. Without signing exchange documents, you don't have an exchange. Very important to understand. So we prepare the exchange documents. This must be done before the sale closes. The exchange must be set up. Exchange documents must be signed before the sale closes. If you close on your sale and try to set up the exchange, it's too late, because we get assigned into the contract as the seller. That's why our documents are so critical. So that happens. Then when the buyer brings in their funds, then the deed is now transferred to the buyer. The money now comes to the qualified intermediary, and the date of the closing is going to start the time frame for the exchange. Our third requirement for to complete the exchange. So this is when the 45 and the 180 calendar days is going to officially begin. It doesn't begin when you list the property. It does not begin when you open escrow. It begins the day the escrow closes. So that's when it starts. Now, you go out and you find your replacement property. We have to get assigned into that contract. So once you get in contract with the purchase, we need to know what's the address of the property you're buying, who is handling the closing. We prepare the replacement property exchange documents, you sign them, and then when you're ready to close, we wire the funds into the closing, and then the deed goes to you. So that's the flow of the exchange. So when you're doing this, you have to make sure that you're getting all the parts together and you're paying close attention to your transaction. Sometimes people get in contract with their purchase and they forget to tell the closing agent that there's a 1031 and they're getting ready to close, and where's the money? Oh, well, it's sitting with my accommodator. So now everything has to stop. We have to go now get all the paperwork we need, prepare the exchange documents, you sign it, and then we can wire the funds. All right, now let's talk about the challenge to the 1031, which is also the fourth guideline, and that's the identification period for the exchange. There are 3 rules for identifying. You only get to select one of the 3. The first and most commonly used rule is the 3 property rule. So as an investor, you can list 3 addresses, but the dollar amount for those properties does not come into play. If you wanted to identify 4 or more addresses, now the dollar amounts for each of those properties are going to come into play, because now you're out of the 3 property rule and you're into the 200% rule. Under the 200% rule, you can identify 4, 5, 6, 10 properties if you wanted to. But when you add up the fair market values of all the properties you're listing, those values cannot exceed 200% or 2 times your sale price. So for example, if I sold something for $900,000 and I listed, say, 6 properties, the aggregate values of all 6 of those properties cannot be more than $1.8 million. Then I can buy whatever combination I want to get to my minimum of buying something for, say, $900,000. If I identify 4 or more properties, but when I add up the prices, the values, it exceeds 200%, we're now into the third and final rule, which is called the 95% rule. Under the 95% rule, unlimited number of properties to identify, unlimited dollar amount. But before you get excited, you have to understand that that 95% means you must acquire 95% of the total value of all the properties you have identified. So you want to stay either in the 200% rule or you want to stay in the 3 property rule. So if you're thinking about utilizing leverage, it's really important to make sure that you're having a conversation, you know, with the qualified intermediary, with your advisor, as to how much cash you have, how much you have to spend, and how is that going to play out for the identification rules. So for example, I had a client that sold a property, say it was $450,000, and there was no loans on the property that was sold. So all cash coming out. In this instant, this client, she wanted to use leverage. So she wanted to take her $400,000 and put down 25%. Well, if you've got $400,000 and you want to put down 25%, that's going to buy you up to about $1.6 million in property. So if she sold for $450,000 and she's identifying multiple properties, 4 or more properties, and to the tune of $1.6 million, which identification rule is she going to be in? The 95% rule, which means she'd have to close on every property. So in these instances, you have to look back to see what can I feasibly get done and what makes sense to complete my exchange. So maybe what she does is she buys some properties with some leverage. And then, so she ended up like identifying, say, 3 properties because of the price point in which she sold and which she was buying. And then maybe later go out and refinance a property to finish off the leverage she wanted to do out of the transaction. So just keep these things in mind when you're considering identifying. And again, the identification comes in when you get closer to the 45th day, okay? Now, the identification must be in writing. You have to describe what you're buying with the address, the city and state of the property, has to be sent by midnight of the 45th day, all right? This is what an identification form looks like. Identification is not just being in contract with the property. So sometimes people say, well, I'm already in contract with the replacement property, but that replacement property is not closing until after the 45th day, and they think being in contract is the identification, and it's not. You still have to fill out that form. So that form must be filled out and sent in by midnight of the 45th day. If you want to change the list, you have to revoke it and replace it, and that has to happen before midnight of the 45th day, because you can only purchase in a 1031 what you have identified. So that's why you generally are going to wait till you get closer to the 45th day before you're going to fill out that form. So hopefully by that point, you'll have an understanding of, yeah, these properties are solid, we'll be able to close on these properties, all right? Very critical to a 1031. And anytime I've ever seen anything where a client is saying we're being audited, one of the things they're going to ask for, either the franchise tax board if you're in California or the IRS, is we want to see proof of when you identified. So that's very critical to the success of a 1031, making sure that you get that form in and it's done properly.
Dino, can I buy, in my situation like what I'm doing, can I buy a house first where I want to buy and then my investment property to exchange?
Okay, so if you're getting in contract with the replacement property before your relinquished property has closed, that's okay, as long as you're going to close on your sale before you close on the purchase. So being in contract with the replacement property is not a problem unless you have to close on the purchase before the sale is closed. Then you're going to be talking about a reverse exchange, which is too much for this webinar tonight. But if you can get it in the order of, yes, you can be in contract with your purchase as long as your purchase closes after your sale closes. We see some of this when people are buying, for example, like new construction. If you're buying new construction, you get the property under contract and it's going to take, 6 months to 9 months. So you might be in contract with that purchase. So now you have to determine, well, when do I start to think about putting my relinquished property on the market for sale? So you can time these two pieces together. So there's a lot of moving parts to a 1031. So in the grand scheme of things, yes, you can do it that way. Just reiterating, to stay a forward exchange, sale closes first, purchase can close the next day after, doesn't matter. As long as your sale closes before your purchase closes, being in contract before your sale closes is not a problem, okay?
Mm-hmm.
Now, what we see sometimes where people are wanting to consolidate, so say, for example, they may have 3 single family rentals and they want to buy maybe a 4-plex, and they want to put them all in the same exchange. You can do that. We call that obviously a multiple property exchange. One of the things to be aware of is that when you're considering doing this type of an exchange, the timing issue for the closing of all 3 of those sales. Because when you're doing a 1031 that's a multiple property exchange, the timeline, the 45 and the 180 calendar days is going to begin at the closing of the first sale. So you want to make sure that properties 2 and 3 in this example are going to get closed as close together. You may not have an ideal situation, but that 3rd sale property must close before you close on the purchase. And then you have to identify, what you're going to buy by the 45th day. And then when you're ready to close, then it's pretty much the same. So if you're considering selling multiple properties to exchange into, say, one larger property, just understand that the time frame for the exchange is going to begin at the closing of the first property, and you cannot close on your purchase until all the properties that are in that exchange have closed. All sale properties have closed. So again, if you're thinking about doing something like this, it's really important to have a conversation with, with me as an accommodator to remind you of the timing of all of this. So for example, if properties 1 and 2 have closed, but you're having a problem with property 3, well, then maybe, and you still have to close on that purchase, maybe you have to pull property 3 out of that exchange and close with just properties 1 and 2. And then later when property 3 sells, you're going to have to go off and buy something completely different. So it's not all lost. There's ways to maneuver around it, but timing is going to be critical for the success in this kind of an exchange. Now, what we see is quite common. People sell 1 and they buy multiple properties, okay? You have to complete your exchange by the 180th calendar day. So usually it's not that big of a deal on the buy side. It's, the more challenge of a multiple property exchange is on the sale side. So very common transactions that we see, somebody selling 1 property and they're buying multiple, they still have to complete the exchange by the 180th calendar day. All right, so let me just go through some tips real quick here. What I like to say for an successful exchange. 1, consult your tax advisor. When you're getting ready to sell an investment property, it's important to talk with your tax advisor to determine, do you need to do a 1031 based on your situation? There's times where you as a taxpayer may have some suspended losses, or you may have something that can offset the gain, and you don't need to do a 1031 on that transaction. You can sell it and then go off and buy, and you're not restricted to the time frames of an exchange. So when you're considering selling, make sure you loop in your tax advisor to determine, do you need to do a 1031 based on your circumstances or not? And then also you want that tax advisor reviewing the closing statements, the one for the sale side and the one for the purchase, just to make sure to see that all the costs that are on there, if there's any potential for any kind of taxes based on the closing statement. So definitely consult your tax advisor. And hopefully you have tax advisors that understand 1031s in real estate. The next requirement is that you want to make sure that when you're entering into this kind of a transaction, that you're discussing the 1031 process with the qualified intermediary. So in other words, you'd have a one-on-one conversation. You're going to understand, we're going to go over what are the rules, what are the guidelines, very similar to what I'm doing right now. I'm going to ask you questions about your transaction specific to what you've got going on. I'm going to take you through the step for what to expect, just like I just did a few minutes ago. This is what we're going to be doing. I'm going to be reaching out to this person. You're going to be receiving the exchange documents via email. Make sure you sign them. If you have any questions, ask. Take you through the process so you understand what to expect when dealing with the qualified intermediary. Become familiar with the requirements for full deferral. So in other words, remember that you have to spend all of the cash. Remember that you have to replace the debt. Understanding how to identify the replacement properties. If you get confused, you want to make sure that you're asking questions about it. I mean, sometimes we had some people that go, well, I understand, I get it. They send in the identification, for example, and they forgot to put the city and the state. They just put the street address. That's not going to work for a 1031. So you want to make sure that when you're identifying the replacement properties properly. So you get familiar with the process itself. The next one is going to be confirm tax ownership to vesting prior to selling. This one is really big, and it happens more often than people think. It's not uncommon for individuals, say, for example, to buy a property a certain way. You're consulting your tax advisor. Your advisor says, I think we need to now start treating this property in a different way. So say, for example, it's a husband and wife, And then because of tax benefits, the accountant says, well, let's go ahead and, turn this into a partnership, an LLC tax as a partnership. But the husband and wife never bothered to change the title, but they've been reporting the property as a partnership, doing a 1065, getting K1s. Now you're going to sell the property. So now Christy's looking at your title report, and she sees, husband and wife as community property. So she's strolling along with that, right? Thinking everything's fine. And now I start getting asked, well, how are you reporting this on your tax returns? Then we find out, oh, it's under the H&W Investment Properties LLC, and we've been filing a 1065 getting K1. So now you're out of sync. Your title does not match your tax reporting. So when you're getting ready to list a property, have Christy take a look at your title to say, and then say, okay, this is what's showing for your vesting. Are you still reporting the property the same way? And if you are, then you're good to go. If you're not, now you need to start working with how to fix that issue. Then you'll loop back in your accountant to determine that. Do I need to correct the vesting? What does the accountant want me to do? So you want to definitely confirm that your tax ownership matches how you're vested on the title. And
Yes.
then last, but yes, go ahead.
I was just gonna say this is a real situation because I had a client that I've had forever, Marshall had a client, and he owns a lot of properties and all of them are in his name, but his brother was a silent partner on them all, and he wanted to sell all 20 of them and then buy all new properties and put them in his brother's name. And I said, you can't do that because they've been only in your name. He goes, yeah, but my brother's my partner. And I said, but he's a silent partner. You have to do the same way. And he goes, but I don't want to own the properties anymore. I want to turn them over to him. And so he's stuck with having to try to sell them and pay taxes or not sell them at all because
Christy, those are real situations where somebody's that has no tax ownership. And when I say tax ownership, I mean they're not reporting it on their tax returns. And then all of a sudden you're getting into escrow, and then Johnny now is coming in, and you can't do it that way. So yeah, everything has to match. And those are some of the issues when people get into situations. If they're not, when they're buying investment property, they should be consulting their tax advisor too, to say, if I'm buying this property with my brother, for example, like you've just stated, if I'm buying this with my brother, but my brother, doesn't want to be on title, he's just giving me some cash, but then the one person alone is on title and only reporting it, that's a problem. So you want to figure out early on how you address those situations so that when you go to sell, you're not faced with this huge tax liability. Okay. Yep. Very important. Okay, and then like I said, the fifth tip is communication. When you're doing a 1031 as an investor, you really need to be proactive in your own transaction. So you want to, if you're not sure about something, ask the professional in the segment that you're not sure about. If it's escrow, if it's real estate, if it's 1031. So ask the questions. For the 1031, you want to remember what those guidelines and timelines are. So be cognizant of when that 45 days happens to be, when that 180th day. Because if you heard me say, I used the word calendar days. It's not business days. So if the 45th day falls on a Saturday, and you still have to get that ID in on that Saturday, my recommendation is you get it in the Friday before, and then that way you can, the qualified intermediary can take a look at it to make sure that you filled it out properly. Okay, now we're not going to necessarily know you've got the addresses right, but at least if you put the address, city, and state, you've signed it, dated it, and sent it in. So those issues, if you're identifying 4 or more properties, then you want to make sure that you're doing the math right too, that you're within the 200%. If you do the math wrong, you may end up being in the 95%, and you can't fix those issues if you're beyond the 45th day. So know your timelines, know when the 45 days is, know when the 180 days falls. Because if the 180th day falls on a Saturday or a Sunday, you need to be closing on, you have to complete your exchange the Friday before. It's not the Monday after. And then stay engaged in your transaction. Stay engaged. I like to say it's going to be your new full-time, part-time job when you're doing a 1031.
And that's true too, Dino, because we just had a Marsh Reddick client last April that sold a place in Los Angeles. He bought a duplex up in Northern California, and he wanted to turn the exchange paperwork in the day before it was due on a weekend. And I said, no, 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 let's not do that. Let's get this in 4 or 5 business days early. We did, and he, sure enough, he had the zip code right and the address right, but he had the city wrong.
Mm-hmm.
He put the city next to it on another property I looked at, and luckily your company saw that the city and the zip didn't match. So then you were able to go in, he was able to go in and correct it and make sure everything was correct. But if he would have turned that in on Sunday night when it was due the next morning, that would have been it. We wouldn't have been able to make the change, and that's a big problem.
Yeah, that's an excellent example. Excellent. So,
Yep.
Okay, well, I'm finished my part, and I apologize for the technical glitches here this evening.
Now, if I change, it's not letting me change. Will you change to the next screen for me? You know?
I got it.
Okay, great. So you can download your free property rating ebook. It is like the Marshall Reddick Real Estate Bible, so to speak. And it's amazing. It's about 38 pages. It's a really easy read. You have access to a financial calculator. If you're going to do anything, go on to our website and you go into the Learn page, and you can look up even at the bottom, marshallreddick.com/ebook. And that's a must for anyone who's an investor in real estate. You can just change the next page for me. Thank you. We have tons of educational videos, articles, and guides on marshallreddick.com/learn. Everything you can think of, as well as all the events that we've taught for years are all on here. There's hundreds, if not thousands, of pages and videos and material, all for free to you all to be able to learn. You can do the next page, please. And here's myself again. Please, I'd be honored to schedule a complimentary free consultation with you and help you on anything that you would like with real estate. As I said prior, I've been with Marsh Reddick since 1996, first as an investor and then as an educator, realtor, and advisor for Marsh Reddick since 2000. So I would be honored to help you, and you can reach me at 818-694-0740, and then of course my email's there as well, and I would absolutely love to help you and speak with you. I'll probably be reaching out to most of you after this event also, just to touch base and see if you need anything.
And the only thing personally I would say is if they have any specific questions, they can email you the questions and for referencing 1031, and then you can forward them to me, and I'll be more than happy to answer them for them.
Absolutely. Thank you. And I'm not sure if there's another page that's not letting me turn. Nope. Okay, so thank you all very much for coming to our event tonight. We're very grateful and honored to have you. And again, please reach out to Dino or myself, or send an email, and I'd be happy, or call, and I'd be happy to answer any questions or forward anything to Dino, and she'd be happy to as well. I hope you all have a wonderful evening. Thank you.